Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Matt Shettenholm, he joins us here. He covers all the litigation for the media telecom space for Bloomberg Intelligence. And Nathan Dean, senior policy analyst at Bloomberg Intelligence, both here in New York City. Matt, let's start with you. I was surprised to see that headline that the Supreme Court will hear the TikTok challenge to the U.S. ban. Give us your thoughts.
This is amazingly fast for the U.S. Supreme Court. At this point, only TikTok had filed a single brief, just filing an application. Usually there's a process before the court grants review. None of that happened here. The court immediately entered an order saying, okay, the deadline is January 19th. We'll hear argument 9 days before that, January 10th. We grant review not just on the stay, not just on the pause of the law. We grant review on the whole case. We're going to take this up, this big First Amendment question, first thing in January.
So what do you make of that?
I mean, it's a good thing. I think it's a positive sign for TikTok that the Supreme Court.
But why was it so fast? Like what does that tell us about something?
I think the Supreme Court sees a very serious legal issue that needs to be resolved quickly. You have the president weighing in on this question and a deadline that's looming, January 19th, of whether the ban is going to take effect or not. So I think the Supreme Court said, we need to take this, we need to take it fast. I don't think it necessarily means that TikTok will prevail, though. I continue to think TikTok probably has an uphill battle in persuading the justices that it's correct on the First Amendment. But at least we know TikTok will get the chance to present an oral argument to the justices now in January.
January 10th, they will present their argument. How long do you think the Supreme Court will take to then rule on it? Presumably before the 19th, right?
All of this is very unusual for the Supreme Court. We are in strange territory here, so I can't look at my statistics from all the other cases. I do think the court is going to try to address this by January 19th. What they could do is say, look, we'll issue an administrative stay to delay that January 19th deadline until we rule. But I wouldn't expect a major delay on that front. I think the court will try to resolve this close to the January 19th deadline.
Wow. I don't think I've ever heard of this for a court that moves quickly that's supreme. This is like truly shocking. It's an unfair question, but like, what's your best guess? Like knowing who's on the court, where they think and how they think about the First Amendment.
Yeah, so I continue to think TikTok faces an uphill battle with this Supreme Court. When you look at how the D.C. Circuit decided this on a unanimous basis, where 2 of the 3 judges were Republican appointed, and now you take that same decision to this Supreme Court tends to nod its head in agreement with the rulings of Naomi Rao and Douglas Ginsburg, who decided this case in overwhelming fashion against TikTok. So does it mean TikTok has an impossible case? No, there's a chance it could prevail here. This is a novel First Amendment question. Lots of ways for the Supreme Court to rule for TikTok, but I think it's uphill for TikTok. I think most likely the Supreme Court says, you know what, the D.C. Circuit got it right.
Yep. All right, Matt, thank you so much for coming in last second here on this breaking news. Matt Shelton, he covers all the litigation across the media and telecom industry, which is a highly regulated set of industries.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, it's Fed Day, so therefore we have the expert on to give her take on what's going to happen, Danielle DiMartino Booth, the CEO and Chief Strategist at QI Research, and she joins us now live. All right, so what are the key points that you're looking for?
So I'm going to be looking to see how measured Powell's comments are and how enthusiastic or not he is about the economy. I'm not so sure that we're going to see as much bravado as we've seen lately. The last time he was at the podium what preceded the latest release of the quarterly census of employment and wages, which took down wage growth quite a bit. The last time we had a dot plot in September, Powell said the Fed is mentally adjusting payroll numbers based on QCEW. I'm reading a Bloomberg headline there. And now we know from the Philadelphia Fed, after they crunched through the numbers, this agrees with Anna Wong's analysis, actually, that payroll losses started in the second quarter of 2024. We're in the weeds here. This is kind of arcane stuff. However, if the Fed is going to be attentive to what the Cleveland Fed is presenting, they expect shelter inflation to decline from 5%. That process has already begun to 2% year over year by the end of 2025. If you pile on the fact that it looks like payroll losses began in the second quarter of 2024, these are elements that are going to have been incorporated into many, many presentations around that big oval table in the Eccles building. These aren't things that they can ignore. And economists, lifelong economists, they're used to having to look into the rearview mirror. It was 5 quarters before we knew that the first quarter of 2001 or the first quarter of 2008 were actually negative GDP prints. The GDP is the last to reflect these. But if we know we're losing jobs as of April of 2024, the Fed's talking about it.
So that would suggest to me, from your commentary, that you would think the Fed would be cutting into 2025, because I think the market's been moving away from that a little bit.
The market has been moving away. Bond traders have been moving in the opposite direction, as Bloomberg's been reporting here over the last 24 hours or so. And I think that I think Powell is going to really lean on, we are data dependent, even with the positive revisions that we saw come out of the latest non-farm payroll report. We still had private job losses in the month of October, despite the comeback that we saw after the Boeing strike. Of course, those Boeing workers are all being let go. In the first quarter, we're seeing the same thing from Stellantis, and a lot of bloodletting in coming out of the manufacturing sector that really has yet to let up. We saw backlogs in S&P Global Manufacturing Indices really fall to their lowest level, and backlogs they're a gauge of future demand. That means that there's going to be more layoffs in the coming year. The industrial recession is definitely starting to bleed into the services economy. We saw that with yesterday morning's New York services survey.
I thought the services were really good. What am I missing?
The headline S&P Global Services was good, but if you look again, I refer back to the QCEW. What S&P Global does not include in their services, which is what ISM does, is construction, retail, mining, and wholesale sales. So once you cut those 4 critical cyclical sectors out, you understand that you really are looking at apples and oranges when you compare S&P Global Services to the United States to what ISM is, which is a much more holistic read, and it's been appreciably weaker, especially on that employment side. But again, where have we seen weakness in services? That would be construction, that would be retail.
Dot plots. We get some dots today.
Plots.
DOTS Go for Bloomberg terminal users out there. You can see where the dot plots, the dots are actually plotting out over the next several periods. What should we look for there?
Well, I'll be looking for whether or not we're going to stay at an anticipated potential 4 rate cuts in 2025. Of course, the question is going to be: are those going to be front loaded, or are they going to be trickled out across the year, 1 per every meeting with the summary of economic projections, or will we see something possibly by January 29th?
What I'm trying to understand is, what would be a good result for the market? So, and how do we categorize that? So, what decision today or what dot plot gives us, I don't know, a higher equity market, gives us lower yields? If we call that a win?
I don't know that we necessarily call it a win if we walk away after Powell's presser this afternoon and say, maybe they are going to be lowering rates at the end of January. I don't
so
think
it's still kind of like, oh, data is not so great, therefore they're actually going to have to cut more than now we were thinking. So it's like a catch-22 now.
It pretty much is. What the market has priced in is all of a 16% probability for another 25 basis point cut at the end of January. I think to the extent that Powell is reticent to talk about things like tariffs, things like the national debt, which he has not wanted to.
Which he won't.
He won't. But given the 2018-2019 playbook, we know that inflation didn't show up for a good 12 months, and that incoming Treasury Secretary Scott Bessent has said he wants to go more slowly than Trump 1.0 tariffs in terms of how they're pushed into the economy. There's so many things that remain to be seen, and you can never tell whether or not it's Bessent we can take for his word or not, because you just need a hot mic
you don't
and
know.
Trump.
Yeah, That's how it could go. Danielle, thank you so much for joining us. Danielle DiMartino Booth. She's the CEO and Chief Strategist at QI Research, joining us here in our Bloomberg Interactive Broker studio.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
There's a ton of car news, so we wanted to dive into that a little bit more. We just had a headline that crossed that California gas car ban actually wins Biden's blessing, which really sets California up in a clash with President-elect Donald Trump. California has rules that require the sale of zero-emission vehicles and ultimately ban the sale of ICE cars by 2035. At the same time, we have a possible tie-up from Honda and Nissan, a tremendous earthquake that we heard really throughout the auto industry. Steve Mann is Bloomberg Intelligence Senior Autos Analyst. Hey, Steve, let's just start with the Nissan-Honda news. What's your biggest takeaway on this?
Well, I'm not too surprised that this is happening. Given the seismic shifts in the auto industry in the last 5 years, with these startups, Tesla, Rivian, Lucid coming on board here locally in the U.S. And globally, and then you have the 800-pound gorilla, the Chinese automakers, really growing fast, not just in their own markets, but globally. So, it's posing a lot of challenges to legacy automaker, and somebody like Nissan, which saw sales on a global level, drop as much as 50% over the past 5 to 6 years.
Wow.
They're going to have to do something to kind of pare costs down.
Would this be enough, Steve, for the combined company to compete on a global scale?
It's tough to say. I think initial thought is no, because Nissan over the past few years have really cut back the number of models in the marketplace. They are overcapacitized. There's a lot of work that needs to be done. So I'm not sure if it really helps Honda in this type of merger. I think the tilt is towards it could be a drag to Honda.
Well, that was my question, is that I was reading that there might not be a ton of synergies in this, that it's just really all about scale. So can the scale be enough to offset that lack of synergy?
Well, I think that's it's going to be the ongoing trend, and every automaker and supplier as well will have to kind of revisit their long-term strategy, because you were saying earlier, California is actually moving away or moving towards all electric. Automakers and suppliers are continually facing, increasing R&D expenditure as the propulsion investment diversifies away from gas and more towards other powertrain system. That's going to be really costly for the automakers. So, and the suppliers, so they're going to have to revisit how they're going to, and make those investments going forward.
Steve, how much do the Japanese automakers have to compete against China? It just feels like it would be more than maybe the U.S. automakers do.
I think so, because if you look at the Japanese automakers, they're really prevalent in emerging markets. Toyota's all over the place, Honda and Nissan as well. They really, those cars, Japanese cars, were considered low cost. So they resonate with the emerging markets. And that's where the Chinese automakers are actually entering. The smaller markets in South America, Southeast Asia, Eastern Europe, really challenging head-to-head with the Japanese automakers, as well as the South Korean automakers.
Really good stuff. Steve, there's just so much to break down through all of this. We appreciate it. Steve Mann joining us, senior autos reporter for Bloomberg Intelligence. I should say analyst, not reporter. My bad. And then there's the Foxconn thing, Foxconn on in. It's so confusing.
Well, the thing about Japan, which I learned early in my career, is there's just a lot of cross investment between companies. Yes. Even if they're out of industry, just different. I think it's just, I can't remember the reason for it other than we're all in it together, and let's have close relationships between companies and management teams and that type of thing.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, joining us, the man. He is fantastic. He knows things about everything. He has opinions on everything and really good insight. And he's the kind of guy where you don't hear what he says anywhere else, and that's really special in this kind of business. Peter Cheer of Academy Securities is joining us in studio. Peter, how are you going to be reading the Fed today and then the market reaction to the Fed today? What's going to be your takeaway come tomorrow?
You know, I'm really expecting a fairly hawkish Fed. I think they are a little bit worried about the economy, but it's not showing up in the data. So I think they're going to have to come across, hey, we're potentially on hold. We've done 100 basis points. Let's see where this plays out. I think that will disappoint the market a little bit, only because we are up so high since the election. Everything's run. I think people got very comfortable. Rates are coming down. I think that stops. I think I'll be paying close attention to the summary of economic projections, or more likely the dot plot, where do they take the terminal rate, and does that move closer to 4%, which would signal that, yes, they are very close to being done.
If the Fed is going to be slower than expected in lowering rates, if not coming to a pause here for maybe all of 2025, can the stock market work in that environment?
I think so. I think the stock market has really moved on to what is Trump going to do? What's Doge going to do? Where do we head from there? And I think there's a lot of optimism. I think, once you move past some of the fears about tariffs, which I think people have kind of fallen into this, maybe a bit of a false sense of security right now that they're negotiating points, I think this is really going to be about, can he do something about the rules and regulations? Can we revisit 20 years of rules and regulations that have been put in place when they had the luxury of being the sole superpower? And now that we're really competing economically with China and the world, do all those make sense? And we've talked more recently, we went from drill baby drill to refine baby refine. And I think the one thing this economy really needs is to process rare earths, critical minerals, energy products ourselves.
So to that point, do we need to rethink a reaction function to the Fed when we don't know what those policies are going to be?
Yeah, so I think the Fed's the reaction's probably going to be fairly mooted one way or the other day. Like, we'll get a bit of movement.
Because he's not going to take the bite on anything that has to do with DC.
Right, and he's going to, we have to wait and see. And again, I think, as the last guest just pointed out, we don't know what's actually going to get implemented day 1 or day 2 or day 3, what's going to be a priority, what falls through the cracks. When I look at it, I think immigration, they're going to go after some highly visible targets that probably most people are in favor of. I think you've already seen New York City Mayor Adams start talking down. So I've always thought the Roosevelt Hotel, that type of situation is going to be the first thing they crack down on, but it's not going to bleed into this wholesale, knocking on doors, kicking in doors, pulling out people and sending them away from the country. So I think that'll be fine. I think in terms of energy, he's going to start enforcing some of the sanctions against both Russia and Iran, partly to force them to some sort of peace deal, also to support our own energy industry. And from there, we'll just see what he comes up.
What he comes up with. Yeah, that'll be interesting. It always is. For those of us in the news business, keeps us on our toes.
Okay, so what do you do? So what do you like? So we're looking at the risk of higher yields than for next year. I'm reading between your lines. We're still talking about that bad breath in the market and the leaders from the NASDAQ 100. What do you do?
So I really like, they've been selling off again, but I do like all the commodity players, all the industries that enable commodity. I really think there's going to be this massive push for some sort of, let's call it security broadly, where we need to produce and refine our own rare earths, critical minerals, and energy. So I think we talk about energy. So I don't think it's really going to be good for the commodity prices, because I think you're going to see more supply come on. But I think you're going to see these companies embrace it. I think you're going to see a big push to create some regulatory, opportunities. And one thing, one of our generals is really keen to point out on, he was very involved in Trump's first negotiations with Xi on tariffs. And Trump feels a little bit cheated by Xi, because Xi had promised to buy a bunch of agricultural products and never followed through. So if there is a deal this time, and I assume there will be one, watch for ag to really benefit, right? He is really going to force Xi to buy it and deliver on that purchases this time. So I think, again, that whole industry. So I look at all the heavy equipment manufacturers, they should do really well in that environment, and they still trade cheap, right? Yeah. AI, some of these others may do very well, but they trade very expensive. This, to me, it feels like it's going to have to catch that momentum, and you're going to have to get that inflow. But if you get those inflows, there's a lot of room for these stocks to run.
Just asking for a friend here. What do you think about the energy space here? Because if we're drilling or refining or whatever, I think that's good for the energy space, but maybe it could not be great for prices.
That's it. I think it's not going to be great for prices, so that'll be a slight, impediment to real growth. But on the other hand, I think he's going to reopen up our ability to export. Right? He's going to create these opportunities. So I think our companies will do very well in this, and I think the energy stocks will way outperform the commodity. So I see an environment where the commodity prices may be stable, slightly down, slightly up, depending on what goes on in terms of economic growth, whereas the stocks can rally 10, 20, 30% even with that.
Yeah, and then to that point, I mean, that's kind of what we saw today, that the idea, well, actually reporting from Bloomberg is the idea that they're going to roll back the EV incentives, but they're going to put more money and stuff in those 100 days into creating the nuts and bolts of how to make those EV cars, like critical minerals and stuff like that. So that's exactly to your point.
Yeah, and the one thing I think we all forget, and I have to remind myself too, is producing and refining commodities is commodity intensive, right? As we build this out, you need steel, you need pipes, you need roads. So it's all very commodity intensive. So that will support the price of commodities as we build this out. And I just don't see any reason Trump won't push for this. I think it's good from a national security standpoint, and it's the sort of thing he likes doing, right? He loves cutting red tape. That's what he did. Whether he's a businessman or more marketing, he loved cutting red tape. So I think this is going to be something that really appeals to him, to Musk, and it's going to be relatively easy for him to get through in many cases.
Also, this is like perfect for Musk. Like if you create a factory that you can source all your critical batteries for Tesla, cool. I mean, that's what he's been trying to do anyway when it comes to Tesla.
Yeah, and just even from a military standpoint, the amount, they had to rip out, I think, a lot of the Huawei chips that were in our military equipment, right? But some of the raw, the rare earths, critical minerals, the refined products are coming from China. Why? The person that we're having the most degree of friction and potentially at most risk with down the road, you would not be wanting anything that goes into your military equipment being sourced primarily from there. So I think that's all going to get changed. It's all going to get pushed. And I think this time what I have liked is, we're calling it Trump 1.5. He's hit the ground running, right? He's already effectively getting stuff lined up to do, unlike the first time around where I think he was kind of a little bit deer in headlights and didn't know what to do day one.
Do we have those rare earths and the minerals and the stuff we need for electric batteries? Do we even have that here in the U.S.? I thought they were in other parts of the world.
There actually are a lot in the U.S. So I think one of the, as government's built out, some of we got rid of the Bureau of Mines. We have not been big at mining things. One story we've heard that seems pretty interesting is where there were a lot of the fracking was done. The water that stays in the ground has actually been absorbing lithium, and so you can extract that water from the evaporate and get lithium, and that's actually probably the most efficient way to do it. So there are all these opportunities, but I do think the big thing is going to be the refining. So I think, to me, right, there are other places in the world we can get the resources themselves from, but how do you refine them? We have to take that responsibility on ourselves, and I think the process has never been green, but the reality is if you let China do it all, it's not green. It's probably not even as green as they say it is. So take that responsibility on your own, do it here, do it domestically. So that's why I think I'm switching more and more to refine baby refine from drill baby drill, because it's all going to be about the processing.
Smart. Yeah, so smart. Also, you remember we used to book Peter as the bond guy and look at how far you've come. So let's talk about bonds though. What do you think we're going to see on the 10-year? And I asked that because T. Rowe Price said we could see 5% in the first quarter of next year and then 6% next year. You think you're going to get a hawkish Fed anyway, and there's going to be all this investment that we're talking about and going through, which could be lead to a lot more growth. What do you think?
I'm not quite that bearish. I think we should be around 440 to 460 on 10s. I think, post-election, everyone got too bearish, so that was an easy call. We got the retracement back down to 415. I've been bearish since then. I want to see, I think, coming into year-end, 440, 460. I think there's a much bigger risk of a gap 50 bips higher than a gap 50 bips lower. I think we've had those moves. And I could see us getting to 5% next year. I struggle with 6%. I just don't think the economy is going to be that good. I think enough people pile into duration at that 5% level. So, and we've kind of for the last 2 years been making lower highs on yields. Every time we sell off, it's not quite as bad as it was before. So I think I'd probably, unless something dramatically changes, I'd be a big buyer of 10s if we got to 5.
Credit risk? Taking any credit risk out there?
Yeah, we've been slowing down. I thought credit was great. We've loved it since June. I'm kind of more neutral on it. Part of what I saw, I think that was really positive, was a lot of banks had not lent enough during the post-Silicon Valley Bank, so they were chasing money. Private credit was getting a lot of money, so all this was coming into the markets. So I've liked credit, and I think we're okay there, but I do think if the economy slows a bit, some parts might do less bad. A lot of things was very dependent on getting, lower floating rates. I don't think we're going to get that to happen as much. So I'm neutralish. I don't see anything wrong with credit. The one thing I will say is I find myself fighting with people on high yield a lot. People keep pulling up these charts of high yield bonds and, oh, look at how tight they are. They're too tight. And to me, the high yield bond market does not look anything like it did 10 years ago. So close your eyes when you pull up these long-dated charts on the high-yield market. It used to be smaller companies, not well-known. It's a much better market.
Yep, very good. Peter, another great performance. Thank you so much. We appreciate it. Peter Cheer, he's head of macro strategy at Academy Securities. Academy Securities, for those of you who don't know, the founders, military. So a lot of the leadership and the ownership of Academy Securities is ex-United States military. So some good folks over there, and we appreciate getting some of Peter's time.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.